Thank you for watching this video. My name is Jerry, and today we're going to talk about the 20-for-1 Google stock split that's happening on July 15th. First, let's cover two stock myths. Myth number one, stocks are cheaper after a stock split. That's complete BS. If you do a 20-for-1 split on $100, you will have $25 bills, but no matter how you split it up, you still have $100. Stock splits are the same, and making the price smaller does not change the fundamentals in any way, shape, or form. The split will offer smaller investors a cheaper entry point into the tech giant. This move doesn't increase the value of Google stock. However, it does offer potential investors the opportunity to buy into shares at a much lower price. And for a company like Alphabet, with a share price more than $2,000, this kind of a stock split really does make sense. Myth number two, stocks go up after they split. Again, complete BS. It completely depends on the stock. Case in point, Amazon did a 20-for-1 stock split on June 6th, where it opened at $125, and 1 month later it is now trading lower at $114. So just because a stock splits doesn't mean it will go up. And in the current bear market, we have to be very careful. And one thing to notice on the Amazon stock split is the stock ran up the week before the split, and we call this buy the hype and sell the news. So there is a possible play here if you want to play the pre-split run-up, which is going on right now. Let's start by taking a quick look at Google's fundamentals with a side-by-side comparison of the FANG stocks. We're now in beastmodeanalysis.com. Just for a quick side-by-side, our emphasis today is going to be on Google, better known as Alphabet. We've got Meta Platforms, formerly Facebook, ticker META, Apple, ticker AAPL, Amazon, AMZN, and Netflix, NFLX. The first thing we want to come down and look at is our PE ratio. Here we can see they're all pretty low. Our highest on the day is Amazon at 53.9. Our lowest is Meta Platforms at 12.2. And we've got Google coming in at a nice healthy 20. From the income statement, we want to look at the operating margin and net income margin. For the operating margin, we want it to be above 10% at a minimum. Our highest on the day is Meta at 39.64, but coming in strong at number 2 is Google at 30.55. And then our net income margin, Google's also coming in very nice at 29.5. So a very good, strong income margin on Google. Let's scroll on down and take a look at the balance sheet. And this tells us whether or not the companies are financially stable. We like to look at the Tattle ratio, which compares the total assets to the total liabilities. And we can see Google is coming in at 3.34. And for total assets, they've got $359.3 billion. Total liabilities are $107.6 billion, giving them a 3.34 Tattle ratio. So that's very strong. And then if we come down a little bit further, we can look at the key performance metrics. Revenue growth last year, 41.15%. So they were the best out of any of these guys. Free cash flow margin, very strong at 26%. Rule of 40 indicator strong at 67.16%. My FNR indicator strong at 96.67%. And then on our BV ratio, we can see they're coming in at 0.16, so nothing to get too excited about there. Then if we come down just a little bit further, we can see under growth metrics, the net income growth last year, 88.8%. So all told, Google is very strong fundamentally. Google's a beast with a 29.5% net profit margin, and these are the types of companies that I like to own. Their revenue growth forecast is 15.9%, which is okay, but nothing to get too excited about. So the question we have to ask, is Google a good buy right now for the long term? One of the ways we can assess the current valuation is to look at the PE ratio over time for the stock. The price to earnings ratio is the ratio for valuing a company that measures its current share price relative to its earnings per share. The price to earnings ratio is calculated by taking the stock price and dividing it by the EPS. This metric is considered a valuation metric that confirms whether the earnings of a company justifies the stock price. There isn't necessarily an optimum PE ratio, since different industries will have different ranges of PE ratios. Because of this, PE ratio is great to evaluate from a relative standpoint with other similar companies. And here, if we look at Google, we can see the current PE ratio is coming in at 20.72. And on this chart, I can go back 5 years, and over the last 5 years, this is the lowest the PE ratio has been. So that is a real good indication. Now I'd like to show you the relationship of the PE ratio to the stock price and earnings per share. So we're now looking at a 10-year chart. Right now we can see that the PE ratio is coming in at 20.49, and this is the lowest that it's been since all the way back here in 2012. And if we look what's happened to the price since then, it was trading at $290.93 all the way up to a high here of $2,897. And on the earnings per share, we can see that they have steadily gone up. Let's see, way back then it was at $16.80.
$2.87 per share. Currently, it is at $110.53. So this is a huge plus for Google, and it just simply shows that the increase in value is happening over time. And right now, our PE ratio is at a 10-year low. Let's take a look at Alphabet's revenue growth over the last 10 years or so. And here, if we can go all the way back to 2012, we can see it was at $42.7 billion. Currently, it is at $270.3 billion. Beautiful. Google's gross profit has the same story. Coming back here in 2012, let's see, we've got $25.9 billion all the way up to $153.9 billion. And now let's look at Google's price history, scrolling on down back in 2012, $313, all the way up to roughly $3,000. And we'll just zoom in on this last section right here. So what we've got right now is Google is trading at a really nice discount. I mean, they're down from $3,000 all the way down here to roughly $2,200. I think it represents a great buy.
So based on the historical PE ratio, Google is very cheap right now and represents a good buy for the long term. Now let's take a look at TipRanks and see what the analysts think of Google.
And here on TipRanks, we can see Google currently has an analyst rating consensus of a strong buy based on 24 buy ratings. There are 0 hold and 0 sell ratings, and the analyst price target is currently $3,100.79, giving it 35.32% of upside. So we've got a real nice analyst view on this stock over at TipRanks.
To sum things up, I like Google for the long term and see it as a good value. The revenue growth is a little low at 15.9%, but I do expect Google will return to its previous highs, and that's about a 30% increase. To sum things up, I think Google is a rock solid company and I'm buying. What are your thoughts on Google? What do you want me to cover in the next video? Let me know in the comments down below. Alright, I really hope that you enjoyed today's video, and if you want to learn how to read charts, trade options, receive our hot stock watch list, use my custom indicators, or get all of our trading alerts, the links are in the description down below. Please be sure to like this video, and remember, we're still in a volatile market, so be careful and trade smart. Peace, and I'll see you on the next video.